Today we're going to be talking about the daily cycle. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. End of a week, it's Friday. We've had our first full week back after the new year. And again, just want to say thank you to everybody and Happy New Year. A ton of great messages. A lot of traders just obviously having time to think over the Christmas and New Year's break, wherever you're at, wherever you're celebrating, and obviously this week getting back. And as per usual, British pound, gold have not disappointed. They've given us trades each day. We're going to talk about that as well. We're going to look at the charts today on the pound, gold, and we'll look at Bitcoin because there's some excellent examples there of not only in a market that's gone vertical, but again, how there is always stop hunts even into strongly moving markets and trends. So again, understanding the concepts that no matter what, they come back to hit the stops on traders who are in profits. We're going to talk about taking profits, your mindset, my approach to the markets, and we're also going to talk about next week, probably getting into more about how I trade the open each session. So let's get started. Again, my emphasis is always at the high and the low. And again, the primary reason is because that's where the stops are. The market will each day start off its cycle by working itself either back up to a previous session or previous day's high, and it may not even take it out. It may just work back up there without pinning through or without taking out that level, but it goes up enough to obviously do whatever work it's done. And in some cases we may have a pin that's up through there and a pullback prior to heading into the session, sometimes in the session timings. But it's important to understand that the market is going to go back to these levels, and when we head into the next session, the question we want to ask ourselves is, are we working the high? Have we done our work up top, or are we working down into the low, and are we looking at possibly working our way back up to go after traders that are in the money? So again, the market will drag traders in one direction. Obviously, for a reason, it's going after profitable traders, or if we're in a trend, it may put in a low of the day or a low heading into the next session. We can see if the market has already made a strong move heading into the 12 candle window, whether that's Asia, London, or New York. All of a sudden it seems it's moving strong, and all of a sudden we head into our 12 candle window and it starts to become a creeping trend. So we've talked about understanding creeping trends. They will typically blow off in one of two ways. They will blow off in the direction of the trend, or they creep and reverse eventually for an explosive move back in the opposite direction for a squeeze. So again, if you're in a trade, if you're trading, again, one of the problems I found with using indicators is that the indicators will often get you selling down low or buying up high, and the market, you're sitting in this trade, an hour goes by, you're still in this trade and it hasn't gone anywhere. Typically when these trades go, they can be over in as little as 1 minute, as many of you know. So, and we're going to talk about a bit more about this in the coming weeks, about trading the open and how I look at opportunities for taking 25 pips out in that first hour, possibly 50 pips in that first hour or hour and a half of the market. But when we get the high and the low in place, this is not a trend. A trend typically will keep making new highs, and then when the next session opens, they may come back into the trend, stopping out traders who have bought up top, and the same thing goes for traders who are buying or selling down low. But working from the top and the bottom, because again, just keep emphasizing, imagine yourself in a trade. How many times have you been stopped out either with a loss or at break even after you've been in profit, and then you kick yourself for either not taking profits or getting caught down low or up high, and then being stopped out with a loss or a very small profit. So keep asking yourself, who's in the money? Where are profitable trades? And that's when the timing window comes into play, because the timing window tells us where we're at in terms of if the market is potentially done doing its work. If we get to the end of that second hour, which is what I call the equities hour, especially in London and New York, and they've already been up to the high, chances are that will now be the high or the low of the day or for that session. So that doesn't mean they may not go back up there one more time, but that's our boundary. So they may work back up into it. So if this is our high, at the end of the equity hour, they may come back and hit it one more time and hit the stops before reversing and rolling over for a fast move or a slow methodical move back now in the other direction, back towards the low of the day. So our timing window is what's critical, because that's what tells us if the market's potentially done doing its work. There will always be a stop hunt. Always, whether it's a trending market, whether it's a range-bound market, or whether it's a false break reversal market. This hour prior to the 12 candle window can often tell us a lot about what's about to happen as we head into the 12 candle window. I talk about if they're working the low, typically that last candle in a 15-minute cycle, okay, 15-minute charts, that last candle may be a inside bar or a bull hammer if it's a squeeze, or if they've been working the low, it may be a small bull pin or a bear pin for the move into the open of the 12 candle window for potentially a 25 pip stop hunt. We might get a breakout pullback and they still may consolidate, but there can often be 25 pip moves right off the bat as we head into the 12 candle window. But again, understanding that hour prior will often help lock in a level either up top or down low before the market, if it's done doing its work. If we've had 3 pushes, or if we're heading into our third push, that last hour can give us a lot of insight. We'll look at some examples on the chart, especially in that last 30 to 45 minutes. Typically there may be an entry in that last 15 minutes prior to the 12 candle window. Now, round numbers. So we're going to look at some examples next week of, again, the opens and how those round numbers, 50s and double zeros, especially on gold, can help us identify accumulation patterns and distribution patterns heading into the open of the session. So again, lots of opportunities there. Now, the pound, though, will often extend to a quarter level in terms of an entry price, but it does love double zeros. The pound loves double zero to double zero, but day to day we may find that quarter level is a resistance or support level prior to the market moving in Asia, London, or New York. Now again, gold, it may trap volume, but it typically will move 50 to 0, 0 to 50, 0 to zeros very consistently, pretty much day in and day out. How do we know when they're done doing business? We'll often see a pin or a stop hunt. Then we get the engulfment, which again locks in the peak formation high or low, or a pin hammer if the market's been extending down and we get a pin, especially if it's the last candle of an hour, locking in that low, and that pin is our evidence of the market being done doing business. Now again, we've talked about this in the past. The market moves 50 pips straight up, gives an engulfment, and traders sell it right off the bat. It's important again to identify where we're at in the numbers. Also the timing cycle. So if you short this, the first candle of an hour that's an engulfment, that could be a trap, because if you understand that hourly rotation, the second candle can head right back up and that hour still ends up as a bull candle moving even higher or lower. And I know traders have been caught, but also we'll usually see possibly a 1, 2, 3 after that. Again, that 1, 2, 3 is evidence after an engulfment that we may be getting a second hit to the high or to the low, which gives us our M or W formation for an extended M, a shortened M, or just a regular M or W for that reversal coming back 25 to 50 pips. So again, understanding that the stops are where the money is, and most stop hunts, if they extend out past a higher low, will typically go 25 to 50 pips above or below the range. So again, understanding that they may, in that timing cycle, we may get to the second hour, or they may be working into the high and not going any further, or they may blow through the high or the low. That's when we can start to target and look for, as our timing window evolves, 25 and 50 pip increment levels above or below the previous session's range for an area of where that market may turn and reverse. And then looking at those numbers and saying to yourself, are they barely getting up to 50, or have they gone by 50 and they're locking it in above 50 underneath 75, or vice versa for the quarter level, all that sort of thing. So again, the price and the time are what's really important to understand, and those levels, if they've broken through a high or a low, are now our potential areas for where we'll look for the opportunities as our timing window starts to expire. So really important stuff. But every day when our session starts, Asia will typically put in a high and then a low, pull back inside. And remember, we talked about, we don't want to be, I don't like to trade inside, because you can get inside and you're caught inside waiting and waiting and waiting. When in the gap times, often what we'll see is they'll come back down one more time for a move heading into our next 12 candle window. They may take out the low or take out the high. If they stay inside, then we can look again for one of these levels to be tested. Have they come down in 3 pushes, or have they come down and set a low and pulled it back inside? So we want to know, are they going to come back and hit the low for an opportunity to come back to the high? And again, that's a different scenario than a market that breaks through a level and keeps going higher and gives us our trending day, where in very rare instances those markets very rarely come back for at least a couple of sessions. So we could see, as we saw last week on gold, a market that right off the gate has broken out of a consolidated narrow range consolidation, and then just trends for the entire 24-hour cycle. So again, we talked about the daily cycle. We haven't gone too much in this, but in the previous videos we've talked about the weekly cycle, day 1, day 2, day 3. I typically look at that as day 1, level 1, day 2, level 2. Level 2 is the days I look for the trend trades. Unless we get a peak formation on a Monday, peak formation on a Tuesday, I'll look for that trending day on a Wednesday. The trending days can be days where traders can make substantial amounts of money because they just keep going and they don't come back. So you can get in, the market moves, there's very little stress, you can get in again, you can get in again and keep adding positions, moving your previous profitable trade up to the next level as you add in positions. So I want to talk just briefly about 3 things that hopefully will help to cement some things together. So again, understanding the power, there is lots of great trades. I know traders now are starting to see this day in and day out when you work from the high and the low. Getting your mindset oriented to just not trying to go to the screen each day and get pips, but stepping back and letting the market give you the easy trades. The trades that move right off the bat. Once you're in, there's no stress, there's no heat, and they just keep moving. And often that takes a little bit of time to start to recognize the best trade setups. I've talked about printing those off, making your playbook, keeping it simple, because when you start to knock out 25 and 50 pips a couple of times a day and just sitting back and waiting for that timing window, especially New York and London, that equities hour will often take traders to a high or to a low and give you some great trades that, again, they fall 25 to 50 pips in a matter of minutes, 15 minutes, half an hour, and it's over. And you sit there and you say to yourself, why don't I just do that every day? Because if you start to do the math on 50, 75 pips a day, and you're just even trading on a standard contract, that's still, $750, $1,000 a day. That can add up just by stepping back and waiting for the simple trades. Not trying to jump and get in and not get caught missing a move let the market set up. Watch the high and the low. Have they already put in a high? Have they been working the low? What do we need to see? If you're not sure, don't worry. You're going to get a chance, whether it's in London, New York, Asia, in gold. There's a trade every session. So, and then this week I'm going to talk about the pound, because the pound this week has given some great trades in Asia. So again, with Brexit, everything happening in the US, and whether you're trading other pairs, the only difference that you may find trading the euro or Aussie dollar, whatever, is you may only get a 25 pip move on most days. And often, like the euro, Wednesday, Monday, Tuesday, Wednesday, you might get a 50, 100 pip move depending on how it's built up. But the other pairs, the reason I stick to these two is they often give 50 pip movements, especially gold, 2-3 times a day. So take profits, program your profit target in. Again, I'm going to talk about trading the opens a bit more next week. I lock in 25. There was a trade yesterday, the day before. It was over in 1 minute for 25 pips. And that's what I like. I like a trade that, like, those are great trades. And the market is already moving. It's getting ready to dump. And there's some fantastic opportunities. It's over fast. There's no heat. And it's locked in. The market takes you out as it's blowing off or moving through a level. And then know yourself. Whatever you're doing that's causing self-sabotage, or you're making money, then you're destroying it. You're making money, you're destroying it, or you're sabotaging it, or you're getting to the screen. Trading can be difficult. You can lose your edge, you can lose your confidence. Little things can throw you off track. It's important just to kind of reorient yourself each day. If you're having a bit of challenge, trade smaller. Trade really small. Just focus on one really good trade. Some days you just feel like you're completely out of sync with the market. Know when you can potentially do damage. Know the days that you could go into tilt. Know the triggers that can put you into tilt. And then just start working backwards and going back again. Your mindset. Stick to the simple stuff. Stick to the simple trades, because when it's simple, there's no effort involved in it, and it becomes easy to just flow with the market, trade in the zone, as Mark Douglas would say. And discipline's not a problem, because you're just sticking to those best trade setups. One of the reasons I like the opening times and this 12 candle window for the 15-minute trades is that I can focus in that. Especially, I really like to be done within that 2 hours, and if I see a squeeze setting up, I'll go for a run. I'll come back later into that end of the third hour. So I just don't feel that sitting at the screen is going to be a benefit. You don't want it. You want to be able to enjoy your lifestyle. So you come to trading for lots of different reasons, but one of them is lifestyle. So don't become a slave to your screen. The longer you're at the screen, the more likely you can do damage to yourself. So we'll take a look at the charts. We're going to look at just the basic cycle. Each day, high and low in Asia. The day starts again, but they hit stops when they set that high and low. We head into the next 12 candle window. They do the same thing. They might expand the range on both sides. They might trend the market. We head into the US session. They might extend it out even further and then reverse it. Or they may hit the high and hit the low again and expand the range even more. We have seen some massive moves on the pound and gold in that US session. So again, thank you for all the great comments and feedback. Thank you for hitting the like button. And again, just working my way through questions and comments, hopefully covering a lot of that in the videos. But most importantly, stick to the highs and the lows. Pay attention to the timing. It's about the money. It's about the money. We'll talk a bit more again in the coming videos. We'll review some of the Y2 10K filings on Goldman Sachs, the amount of money that they're pulling out of the markets. Gold had a 600 pip drop the other day. I would have flushed out a ton of people that were holding on to gold, thinking it's just going to keep going up as we headed into the next month. So stay disciplined, stay focused, traders. Daily cycle, highs and lows. It's where the money is. Don't get caught on the inside. Have a great trading session, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. Continuing our discussion, just looking at the daily cycle, understanding the importance of the high and the low and where the stops are, and that each session will hit the stops. The market's job for the most part is to disappoint as many people as possible. So that comes back to traders being stopped out with a loss, being stopped out at break even after being up money and not taking money off the table, or being caught down low when the market reverses, or caught up high when the market reverses, and either holding on to a loser or having a small loss grow into a big one. But all the little things that the market's designed to do to trap us. And one of the things that I just took me a long time to just really train myself to do is to just work from the high and the low. We see the market come, every single day. I look at the highs and the lows from each session, and before the 12 candle window in Asia starts, I always ask myself is, where have they gone? What have they done in the pre-market? And we see the market has come up, hit the high, worked back down, but again, in that last candle of the hour prior to the 12 candle window, we see a bullpen hammer, and we know that the market is still inside of highs and lows. And again, we see the market move up 1, 2, 3 before we get a bear candle. So again, traders may be long here, and again, this is from top to bottom over 50 pips. And we'll talk a bit more about this in the coming few weeks about how I trade the open. I like to take money off the table right off the bat, and then the market, so there's a 25 to 50 pip movement in many cases right off the bat. And this is an example why the market may go up, take traders up like it's going to do a stop hunt and hit the highs from the previous session, but it doesn't get there, and it turns at the numbers, a little inside bar before stop hunting back down on traders that are caught right off the bat. But again, the market initially works up, puts a high in place, and makes a new high. So it puts a high in place, hits the stops on traders that are short, and then extends that high out before pulling back and giving us a low of the day. So we have a swing low at the beginning of Asia, and then we have a low that, again, traders shorting this down to the low of the day. They don't quite get there. And this is another example of how the market will take you in a direction. You may have a profit target. There may be profit targets above the high or at the high. And again, the market heads up to numbers, taps the numbers and reverses, comes down to the numbers without taking out the low of the day before reversing. And again, just understanding the timing window, we have 1 hour up. So when they break these highs, you're triggering 1 hour traders now into the market. They come back down, and they trigger the low of the first hour, which again may get traders shorting this market on the longer time frames before putting in a low and then reversing back inside. So again, makes a high, makes a low, pulls back inside, goes sideways, then the market comes to life in the gap time, hits the high, comes back inside. So again, stops out traders that are short, triggers breakout orders on traders thinking this is going to run away without them, pulls back inside, hits the stops on traders that are long in that second hour of Asia. So again, you can see that hitting stops does not always involve taking out the low or the high. It can just in general take out traders at break even. So again, when you see this, hits the stops, consolidates, bullpen hammer, you need to be thinking to yourself, this could be the direction of the trade. This guy's got it right, but he's in early. He didn't take any money off the table possibly, so they've come back to stop him out at break even. First mouse gets stopped out. The second mouse gets the cheese. So we head into our end of our hour prior to the 12 candle window in London, and again the market goes 1, 2, 3 and consolidates and continues in London for a move back to the end of the 3 hour window. So this hour, this middle hour, gives us a high and low. The third hour takes that high further out. So not only are we past the round numbers, we're 25 and then 50 pips above the Asian consolidation before we get our engulfment, the inside bar engulfment, short off the double zeros for a 100 pip move back down through the low of the day. So we get higher lows, we get traders buying higher. Each time they buy, they're buying higher. Every entry candle takes the traders higher up. So again, the importance of taking a profit. You're up 50 pips, 25 to 50 pips. taking profits, especially when we get a consolidation outside of the range, a quarter level above double zeros, understanding that this is a double zero box. We've gone 25 pips above and then sideways, which again is a stop hunt on traders possibly who were short at the end of the US session 12 candle window before coming back and hitting the stops at the previous day's low. We come back, hit the previous day's low. We trigger breakout orders on traders that are shorting possibly end of day, 4 hour, whatever that may be, and we know they probably have stops now above the high of the day. Consolidation and a breakout candle in the US session 12 candle window. So each session, so we get a high, we get a low, market hits the high, consolidates, goes back and extends the high, comes back down, extends the low, expands the range on both sides at the bottom and top of the double zero box before reversing and taking out the high. So again, next day we see a consolidation where the market then comes to the high. So we see 3 pushes down, bottom of the double zero box. Asia goes up and gives us a high of the day. We have a high of the day now. Works its way down in 3 pushes, pulls back, comes back to the high. We now have a low of the day. So we have a low of the day at the end of the Asian 12 candle window, and we have a high of the day. The market comes back in 3 pushes, 1 push, 2 push, 3 pushes in the London 12 candle window, inside bar at the previous day's high off the round numbers for the 50 pip move down through the low of the day. The range expands 25 pips below the Asian consolidation. In 3 pushes into the US session, they extend it down 25 more pips, taking out the stops at the low of the day before pinning off the round numbers and a reversal engulfment for a move back up towards the high of the day. So again, just setting a high, setting a low, and then working one side, breaking out, trending, or just working into it for the squeeze and the reversal. And again, looking at your round number boxes. Where are we at a double zero? Have they gone outside of the range? This is a 100 pip box. They worked the high, then they worked the low, and then they came back and went to the other side. The next day, we see the market put in a high, and then bang, it expands the high even more further. For engulfing in our the end of our second hour, equities hour, pinning up to round numbers, double zeros, so they've gone up 100, 200 pips, putting in a high of the day. We have a swing low. The market, again, just talking about the daily cycle, putting in a low, putting in a high. They eventually come down and work the low of the day. They work the low. They put a pin in place, and then they work back down towards the low, extending the low further down. Where does it go to? Double zeros. The pin goes down, touches the previous day's low, pinning down to double zeros. So again, understanding 3 levels of drop: 100, 200, and 300 pips. They hit the previous day's low. This second hour prior to the 12 candle window reverses, and then we get a little bullpen hammer at the end of our hour prior to the US session. So again, we get our shortened W formation blowing off, and then a second push into the peak formation low for our W. So again, just understanding the timing. So not hindsight, not woulda, shoulda, coulda. This is all clearly spelled out with the timings and the high and the low of the day. The round numbers, all of this is right in front of us every single day. So again, just patiently understanding if you're going to be in a trade working in one direction, you want to be selling high in a downtrend. How do we do that? We wait for a stop hunt. So we wait for a 25 to 50 pip move into the trend. If we have an opportunity to sell high, we want to see an engulfment after the market has extended up 25, 50 pips above a consolidation or above a previous day's range. Obviously, in this scenario, we've gone up 300 pips, 3 levels of rise. But this engulfment occurs at the end of our equities hour off double zeros, drops down 25 pips and goes into consolidation at 50, which is midway of this 100 pip box, before dropping down. Our first target will be the low of the swing low. They blow through that. And again, setting a high, setting a low, working into one side. They're extending the low of the day. They're extending the range further down, which is obviously a stop hunt on profitable traders from the previous U.S. session. Who's in the money? All these simple things. Going back, when you see a free open space like this, understand the market will come back. If we're looking for a long trade, we want to see a W. If we're looking for a short trade, we want to see an M. Again, we start our daily cycle again. The market comes back inside, goes into consolidation after working its way down into the low, gives us a high, pulls back inside, giving us our low off of 50s and double zeros. Obviously went 25 pips above the double zero, so this upper quarter could potentially be an area for trapping volume up top. The market comes up 1, 2, 3 in our equity hour, double inside bar before dropping back 25 pips. Again, an example of taking profits. This is our first leg. We didn't have a middle structure when this came off the high. That second leg up to the high, traders could be targeting 50 pips because now we have a middle structure where if they are going to come and hit the stops on the middle structure, takes them almost the full 50 pips from above the double zeros to below this middle structure. Keeping it simple. Where is the high? Where is the low? What time is it? How does price behave when it gets there? So we redraw our highs and lows. Hit the stops, pull it back inside, go to the other side. So we want to see the market hit these stops, whether they're just barely touching them, again, whether they blow through and it's going to be a breakout pullback, but we want to see the market tap out traders that are in the money. We get a swing low into the close of the session. The market works its way up just underneath the previous day's high before pulling back. So an example again of where the market doesn't necessarily have to stop out the overall high or low. They may just go up enough to get traders either put them in heat. If this trader shorted it, his stop may have been above that bar or a break even. Pin bar traders may have stops up top, but they've obviously been up 50, 75 pips and not taken any money off the table. They presumably may have been a break even. All these scenarios. So we see the market work its way up to the top in 3 pushes. Gives us a high of the day. We have a low of the day in place. We have a high of the day in place. The market then proceeds to work down without taking out the low of the day in that London window. So again, we talked about the longer a market works down, you got to be thinking squeeze. Works its way into one box, 1 quarter level box without going anywhere. I'm thinking a squeeze building up big time. We get lower highs. Market eventually pins through the low and then engulfs in the beginning of the U.S. session 12 candle window. So again, people ask often, what's a 1 bar stop? If we're selling up top or buying down low, the trade that gets us, the bar that gets us into the trade typically will be our stop loss bar. Engulfment, pin hammer, an example of a pin hammer, then the engulfment. And we have a micro M double top formation underneath the previous day's high, but we get the pin to the low, then the engulfment before the market takes off. So again, you may have sat in this for an hour, but the market clearly had engulfed the low of the day after trapping all this volume in the lower quarter. Something like this, you're still sitting there with your 1 bar stop. The market may put heat into you, but you're not actually in a loss until you get stopped out. Again, the next day, the market works its way up, giving us our M pattern after pinning up to double zeros, putting in a middle structure, and again, putting in a high of the day. Comes down in 3 pushes and gives us a low of the day as we head into our London 12 candle window. So again, just understanding high of the day, low of the day, then the market comes back, hits the stops on traders that are short on the lower level before working its way back up, goes into consolidation, and then the U.S. session takes out the high of the day. So where is the money? Who's in the money? These traders haven't been stopped out that I know of just yet. We'll see. But again, an example of where they put in a high, put in a low, pull it back inside, and then hit the stops. So again, just getting the idea, this is an example of a very strong trend day. So the market made a high in the first hour, broke out right off the bat in Asia, trended for 3 hours. So even in a strongly trending market, we still want to buy low or sell high. The market comes back in 3 pushes, 50 pips from the high before giving us a 3-bar reversal engulfment just in that gap time. Understanding that you don't want to be buying up high in a market that's trending like this. You'll get lured into chasing this with indicators showing that this is just going to keep going straight up. All of a sudden we get to the end of our 12 candle window and it's a creeping trend for 50 pips back against your move, which people say, well, just buy and hold. But if you put any size on that and you get a 50 pip stop hunt into your position, that could hurt if you're trading a large enough set of contracts. So again, the same thing happens. We go up in London. The equities hour puts in a high of the day, comes back in 3 pushes, 50 pips from the high, 50 pips from the high in the first session, 50 pips from the high after London, engulfment, and again an example of where traders buy the engulfment. It works back up to the high, hits the stops, creeper down, putting heat into traders who are long, who obviously maybe haven't taken profits or who are holding on, who may be stopped out at break even, or holding on in hope mode, hoping that it comes off the double zeros for one more push to the high. Again, keep asking yourself, where is the money? And in a strongly trending market, you'll see that they just keep coming back and hitting the stops and trending, hitting the stops, trending, before finally putting in a peak formation in 3 pushes and closing into consolidation before we head into the next day. But you'll notice creeping trend right up to the high of the day, strongly trending market, 100 pip move into the trend, which again is a stop hunt on traders who are buying maybe late in the session, buying on the 3rd level, not taking any money off, thinking it's going to be a second day trade, and the market comes back right off the bat, triggers at longer term time frame traders into the market before coming back 100 pips, putting heat into traders before consolidating, giving us our W formation and moving back up another 100 pips. So you get the idea. Big move down earlier this week, massive move off the high of the week, Monday, Tuesday, Wednesday, works back up to the high before rolling over. And again, these markets can do anything when they want to. Narrow range day yesterday, again, great example of putting in a high, hitting the stops, putting in a low, 3 pushes, hitting the stops, pulling it back inside, hitting them again in the US session before pulling back and going into consolidation. Today we see something very similar. We see the market pull into consolidation, works up higher before reversing and engulfing 25 pips above the 50 pip box, taking out the middle structure, giving us a multi-time frame M formation for creeping trend down into the previous day's low. So as we creep down, we may see a blow off. Again, coming back to our trade earlier from traders that were long on the 31st, this market could have a blow off move brewing, possibly heading down lower, or we could see this creep into the London session for a reversal and a short trade back up. But currently as we speak, this market still could end up being a blow off move. We'll have to see how it trades as we head into the Europe London Open. So again, just looking at a couple of days on the British pound, same scenario. Again, you can map this out on your own charts. Doesn't matter what kind of charting package you're using. Market comes up and puts a high of the day in place, which means we now have a low of the day, but you'll notice we have swing lows and we have a high of the day. The market comes back at the beginning of the 12 candle window to hit the high one more time before giving us the inside bar for our M formation, middle structure, and then the move off of 25. So again, an example of where the pound may come off of quarter levels a bit more in terms of the trading price level. The pound loves double zeros. We come through the double zero, so 25 above, 25 below. It pulls back to the double zeros and works its way back down. So again, drawing our highs, drawing our lows as the day progresses. People ask me all the time, is it just the session? Is it previous days? Is it, lower highs, higher lows? They're all relevant. If there's a low there, or a lower high, just remember, there's stops above there. The lower, if it's a creeper down and you're getting consistently lower highs or higher lows, remember, when they get down at some point, we may see a reversal for an explosive move in the opposite direction. These lower highs give us fuel for the move back up. So we see the engulfment and pin hammer, the triple combination, 3-bar combination. So again, an example of a low. You're at the low. It's a stop hunt on the previous day's W. We get the reversal bar and then the pin hammer. And again, this is at the beginning of the equities hour. Boom. From number to number, it's a 50 pip move back up to the traders who are short. So remember, who's in the money? Where's this going to go? So having a pre-programmed profit target or recognizing the number levels that this could go to, and then watching how price behaves when it gets up there. So again, high and low, they expand the range. We redraw our highs and lows. The market comes down. Okay, this is the low of the day now. So they're not working the high, they're working the low. Some traders get caught in the gap time buying the engulfment. All this is a move down. So the first mouse gets stopped out, and the second mouse gets the cheese. Second mouse gets the cheese on the stop hunt back up to traders that were short in the 12 candle window. So again, timing's high and low of the day. It's super important just to think simple. Think simple, simple, simple. Market comes up just outside of the double zeros. Stop hunting traders that are short. Again, not having to go all the way to the high or all the way to the low. But the market, as if it's pinning through a level, it's making new lows. Pulls back, rolls over. This little bear follow-through bull candle that once it breaks that low at the double zeros, this second candle, the second grab at the cash is always your telltale opportunity to get in a trade. This is the failed follow-through. The market breaks through the small bull pin off double zeros for a 50 pip move back down through the low of the day to the previous day's low. And again, we're into today. The market went down and made a low of the day, so we have a high of the day. But we also have stops above that U.S. close swing high, which looks like we're heading there right now. So we could see a breakout through that level, or we could see a move possibly come back down below these traders right here, back down to 50. So we see that the traders getting in early. They've taken out the high of the Asian session. We get the swing for the long trade. If this doesn't follow through, we may see a stop hunt back down through these higher level longs. And again, peak formation from last night, we could see this market roll back through to yesterday's low, but we may just see a stop hunt down and then a move back up through the high towards yesterday's high of the day. So hopefully you got value from today's video, traders. Just the daily cycle, highs and lows. Put in a high, put in a low. Which side does the market work? What time is it? Does it break out, or is it working into a level for a reversal trade? Again, keeping it so simple that you can reproduce that day in and day out. Stick to the easy trades. 25, 50, 75 pips a day can add up. Have a great trading session, traders, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.